Okay, so let's get right into it. You've probably heard it everywhere, right? This constant talk of a soft landing for the economy. But what if that's just a nice story we're telling ourselves? Today, we're going to challenge that popular idea and, more importantly, talk about what you can do to prepare for what might really be coming.
I mean, this quote just nails it, doesn't it? The whole soft landing thing, it's the perfect lullaby. It's this super comforting idea that the Fed can just perfectly tap the brakes, cool things down, and nobody gets hurt. It's a great story, helps everyone sleep a little better at night. But, well, let's just say we need to take a much closer look at that story. All right, just to make sure we're all on the same page here, what is a soft landing? Well, think of it like this. It's the Fed trying to thread a needle while riding a roller coaster. Seriously, they're trying to slow down this massive overheating economy just enough to beat back inflation, but not so hard that they slam on the brakes and send the whole thing flying through the windshield into a recession. It's a really, really tricky maneuver. But that's the theory. The big question is, has it ever actually worked? I mean, at the end of the day, theories are nice, but what really matters for our portfolios is the track record. So let's see what history has to say about it. And, well, here's the kicker. The history is pretty darn clear on this. When inflation has been running hot, above 4%, the Fed has never pulled off a soft landing. Not once. The medicine it takes to kill high inflation, jacking up interest rates, it almost always comes with a really nasty side effect. And that side effect is usually a recession. So this gentle, perfect landing everyone's dreaming about, historically, it's just never happened in this kind of environment. So you've got this split, right? On one side, you have the soft landing fantasy. It's this beautiful picture of a gentle glide into prosperity. No pain, no recession, everything's great. But then there's the hard landing reality. And that's a world where interest rates have to stay high for longer, credit gets tight, borrowing becomes expensive, and, well, the economy just kind of buckles under all that pressure. And look, this isn't just some abstract theory. We're already seeing the cracks appear. I mean, credit card delinquencies are hitting highs we haven't seen since the 2008 financial crisis. Small business optimism? It's circling the drain, near decade lows. And corporate bankruptcies are climbing way faster than anyone expected. You put all that together, and it doesn't exactly scream smooth landing, does it? Okay, so if things are probably gonna get bumpy, what do? How do you prepare for it? Well, that brings us to the whole point of this discussion. You need a financial parachute. And the whole idea here is pretty straightforward. Instead of crossing your fingers and betting on this perfect, never-before-seen landing, the smarter play is to just prepare for gravity. Assume it's coming. And the best way to do that? With high-quality, rock-solid dividend stocks. Companies that have a long, proven history of paying you no matter what the economy is doing. This is such a great way to think about it. These stocks aren't magic. They won't stop the fall. Let's be real, nothing can. But they're like an airbag for your portfolio. When things get rough, they're there to cushion the blow, absorb a lot of the impact, and help protect you from the worst of the damage. It's all about making the landing survivable. All right, let's make this real. Our first case study is a classic, Johnson & Johnson. I mean, when you think of a steady, reliable company, J&J has got to be at the top of the list, right? So why is J&J such a rock? Well, if you look under the hood, their business is basically split 50-50 between two things, pharmaceuticals and medical tech. And here's the thing about those sectors. They're about as recession-proof as you can get. People don't just stop needing their medicine or medical devices when the economy takes a dip. That creates a super predictable, super stable stream of revenue year in and year out. Okay, now before we go to the next slide, we need to talk about a very special title, Dividend King. This isn't just any company that pays a dividend. Oh no. A Dividend King is a company that has increased its dividend every single year for at least 50 years. We're talking about a tiny, incredibly elite club of the most durable, most reliable businesses on Earth. And for J&J, 62 years. Just think about that for a second. 62 consecutive years of dividend increases. That means through every recession, every market crash, every crisis you can think of over the last 6 decades, Johnson & Johnson has given its shareholders a raise. If that's not the definition of stability, I don't know what is. And if you look at the stats today, it still looks really solid. You're getting a nice dividend yield of around 3.4%. The payout ratio is super conservative, only about 45%. What that means is they're not stretching to pay you, they have tons of cash left over to grow the business. And on top of all that, it's trading at a pretty modest valuation, around 15 times forward earnings, which is a good bit cheaper than many of its peers. Okay, on to our next case study.
Let's look at another defensive giant, but from a totally different world. This is a name you absolutely know, but you might not think of it as a fortress. Let's talk about PepsiCo.
So here's the thing that a lot of people miss about PepsiCo. You see the name and you think, soda. But really, it's a food company. More than half its revenue, 58%, comes from food. We're talking Lay's, Doritos, Quaker Oats, the whole snack aisle. And think about it, when times get tough, people might not buy a new car, but they definitely buy comfort snacks. That makes their business incredibly durable.
And this is their superpower, especially right now. They were able to raise prices by over 14%, and people barely blinked. Volume hardly dropped at all. That, my friends, is called pricing power. And in an inflationary world, that is an absolutely massive advantage to have. And you guessed it, PepsiCo is also a dividend king. 52 straight years of raising that dividend. Another card-carrying member of that super elite club we were talking about. Just pure, consistent reliability.
The numbers here paint a very similar picture of strength. You get a solid yield around 3.1%. The payout ratio is totally healthy at 65%. Now, you'll notice the valuation is a little higher, about 21 times forward earnings. But you can think of that premium as a kind of insurance policy. You're paying a little bit extra for that durability, for that peace of mind.
So you might be thinking, okay, this is great, but why not just play it safe and buy some bonds? It's a fair question. Let's really break down why these dividend giants can actually have a huge advantage over bonds, especially in the world we're in right now.
This really lays it all out. First, inflation protection. Guys like JNJ and Pepsi can raise their prices. They have pricing power. Bonds? Nope, they can't. Your payment is fixed. Then there's the income stream. With these stocks, it's a growing stream of income. With bonds, it's a fixed stream of income. And that means when it comes to having a cushion for a downturn, these dividend growers have a much, much stronger one. It's not even close.
And you know, there's another piece to this that's less about the numbers and more about psychology. It's a huge point. When the market is going crazy and everything is red, actually seeing that cash dividend hit your account every quarter, it's a powerful thing. It's this tangible reminder that your investment is still working for you, and it can be just the thing that stops you from panic selling at the absolute worst moment.
So let's wrap this up with a really powerful, simple idea. Forget the soft landing. Assume the bump is coming. At the end of the day, this isn't about trying to predict the future. It's about preparation. It's about stop hoping for some perfect magical outcome and instead building a portfolio that's tough enough to handle what's realistically coming our way.
And that's really the question I want to leave you with. Take a hard look at your own portfolio and ask yourself, is it built with a parachute? Because when the turbulence hits, and it's always a question of when, not if, are you going to be ready for it?